This chapter on foreign exchange exposure and risk management is in continuation to what we have been discussing in the last chapter about foreign exchange dealing. So once a company or a firm or an individual is dealing in foreign exchange, then he is exposed to certain amount of risk. Predominantly the risk that we talked about is the exchange rate fluctuation, and how in that case then one go about managing such risk, and how the rates are quoted, how do you interpret the quotes in the market, how do you buy, sell currencies, enter into kind of a derivative contract to manage and protect your risk. So all this concept is what we're going to discuss in this chapter. So let's try and start with the first topic. The first topic in this chapter is foreign currency market. So the idea is to understand this market broadly, and predominantly you get a concept question from this particular topic in the form of short notes or something. But then there has been, of late it has been so that you get a concept question, but there has been some occasions where you even get questions to make up some accounts, which is maintained in foreign exchange dealing. So let's try and see how this market is and what this market is all about. Now if you see here, the foreign exchange market is a market in which individual firms, dealers, banks, they buy and sell foreign currencies, or they exchange foreign currencies. Now when you're talking of buying, selling foreign currencies, it's as if like a currency is a commodity in this market. So how do they do that? How do we interpret quotations rates is what we'll discuss going further. But then this is a market which is predominantly over the phone market or over the counter market. You go to a bank, you approach your dealer, and you deal in different currency transactions. And the purpose of foreign exchange market is to permit the transfer of purchasing power in denomination of one currency to another currency. So somebody is exporting a consignment to US, amount of worth of consignment that is sending from India, how much is it worth in US, that in turn should be realized when he wants it, is his payment to be made here. So how much would that be? Because of economies being different, because of conditions being different, not actually a rupee is equal to a dollar. So how much is that? Is that what we're talking of when we are dealing in this market? So if I'm sending 10 million worth of rupees consignment from here, it's not actually 10 million worth of dollars there, but then end of the day, being a domestic player, being somebody who is in India, he wants his 10 lakh worth of rupees. So that is what is what we're talking of in trade. And when you're trading with different countries, cross borders, you deal in different currencies, so there has to be some mechanism wherein you can get that kind of a purchasing power denomination in your currency that you're sending a consignment abroad. So when you're doing a trade in one currency to another currency, how much is that purchasing denomination of one currency with another currency is what this market is trying to give you a quote. And predominantly of late it has been driven by law of demand and supply. So end of the day, any mechanism in the market for determining of price is law of demand and supply. Now as logical that it would be inconvenient for an individual buyer or seller to go and seek out the rates at which they could probably have this purchasing power denominations been given in one currency with another currency. So foreign exchange market is actually developed by a set of intermediaries, and these intermediaries would act on behalf of their client, on behalf of their customer, and would provide services. So in turn, in offering those services, they get their commission. So predominantly we're talking of a dealer network and a banking network which actually works like an intermediary in this particular market. Now there is a foreign exchange dealers regulation which is governed by RBI. So RBI is the one who looks after such regulations, but there is a Foreign Exchange Dealer Association of India, and there is a Rule 6 Act which is under the Foreign Exchange Regulations Act, and that particular act would determine and communicate and probably would be a kind of a guiding factor for how much a bank should be charging for what type of deal, or how much should be the commission that they should be charging for what type of transactions, and what all transactions are allowed that they can conduct, and to do those transactions what all documentations are required. Now those aspects goes into foreign trade. So we are not actually going into that. What we're talking of is that if somebody within a corporate finance activity is dealing cross border, is dealing in different currencies, is dealing in trades which is cross countries, so he would be wanting to know what is his purchasing power denomination of the currency in some other currency. So how do I know that? By approaching a market where there are dealers, where there are banks, where there are intermediaries who would give a quote to me, who would tell me how much is a rupee worth in dollars, how much is a rupee worth in British pound, how much is a rupee worth in Japanese yen, or in euro. Okay, so that is what you're looking for when you're talking of foreign exchange market. Now, as I said, that this market is developed by an act of participants, by an act of intermediaries. So let's try and understand who those participants are. Okay, who are the participants in foreign exchange market? Now, they can broadly be categorized as non-banking entities. There could be non-banking entities like many multinational companies. They exchange currencies to meet their import and export requirements, and even in case of hedging, as they would be exposed to some kind of a transactions that would be kept open or would be subject to realization, and during that particular duration when the firm is actually getting the kind of pain, the exchange rate could fluctuate. So in that case, he is exposed to a risk. So to manage those risks, we have talked of in derivative that you have a mechanism of hedging. Okay, so even at an individual level, there is an exchange of currency happening as per the need of an individual. If somebody is traveling abroad or wanting to remit to his parent, or if he's staying abroad as an Indian national or an NRI and is remitting some money to his parents out in India, even that time he needs to be dealing with some activities. So when you're talking of non-bank entities who are participating in this market, they are firms, they are individuals who deal in different currencies. Okay. Now, apart from that, there are banks. Banks predominantly is the major player in this market. So banks, they also exchange currencies as per the requirement of the client, predominantly to service the trade, okay, of the client. So although they would be governed by some bylaws, some regulations, some documentation, some foreign exchange regulations in the form of, okay, and anyway, even the foreign trade documentations in that sense, but then they are a predominant player. Okay, banks are predominant player in this market. Apart from that, there is no market where you can take out the charm of speculation. Okay, so there are a lot of speculators. Broadly, we understood that speculators are individuals or institutions who have some view of an outcome and they take a chance on that. As I said, it's actually not gamble, in the sense that they don't actually they base their opinion on the basis of certain knowledge, okay, or certain kind of credentials, capabilities, okay, and they take advantage of that. So these are categories of individual commercial or investment banks, multinational companies, or hedge funds. They buy and sell currencies. Okay, they buy and sell dollars, they will buy and sell euros, they'll buy and sell pounds, with a view of making a profit due to the fluctuation. So if something can be bought today at a lower price and tomorrow it can fluctuate and go up, and you can sell it at a higher price, you make profit. Now, this exchange rate is subject to multiple factors. Fluctuations might happen because of those factors. It doesn't work in vacuum. Anything in the market does not work in vacuum. So if you have a view that dollar is going to be strong, okay, in this market, when we say strong, that means for every rupee, a rupee being weak, that means dollars, you're going to part with many rupees to buy a dollar. Okay. So in that case, you know what to do. Okay, you would be in a position to make profit out of that. So depending upon your credentials, your capabilities of understanding which currency is going to be strong, which currency is going to be weak, you do a trade in this market, and by doing such trade, you end up making profits. Okay, and obviously being a speculator, you are exposed to high amount of risk, so you might also be making losses depending upon whether your views have gone right or wrong. Okay, now apart from that, we have talked about another type of player in these markets, arbitragers. Now, arbitragers are institutions, individuals that we understood who simultaneously take exposure in two different markets to make a risk-free profit. Okay, and because of their involvement in markets, you see market coming at equilibrium, market becoming at equilibrium. Okay, so that is what is the main role of an arbitrager. and for arbitraging you need to simultaneously buy and sell, so you need resources also. Okay, so this category would include investors who make profit from price differentiation, because it's a global market. There are multiple places in which they can identify what is the pricing available, and they could identify a mispricing. Okay, they could spot a mispricing, and if they are able to do that, then they are there to exploit that as well. And that is how they do. They do a simultaneous buying and selling in such market. Now, the biggest reason why foreign capital is attracted by Indian market is to eat up this arbitrage profit only. Okay, there have been people who have an opinion in the market that the Indian markets are dependent predominantly on FIIs. It's not wrong in the sense that they're a huge player. If they decide to enter into a market and they buy in huge bulk quantities, so if they start buying, then you can't stop the market from going up. Okay, if they sell, you can't stop the market from falling down. But then it's not as if that they're compelled to come to India. Okay, or it's not as if that they see a kind of a growth story that normally that we project when we communicate that the India is a destination for them. But invariably 70% of flows, cash flows, which happens through foreign investment in Indian market is to eat up an arbitrage opportunity which is prevailing. Okay, and any amount of profit that you can make without a risk is your profit. Okay, is a risk-free profit, and if you have resource, you would try and exploit that. Okay, so let's try and take help of a illustration to understand what I'm trying to communicate. That, and it's very important. It's very important for finance professions to understand that it's not that FIs are for FIs it's imperative to come to India, because they get a better opportunity, a better arbitrage opportunity. Okay, and because of that they come to India. So end of the day, if you are able to keep that kind of an arbitrage opportunity, they would always be attracted to Indian market. Okay, so let's try and see one illustration what I'm talking in that sense, and very important, very valuable piece of information that we are sharing. Now, supposingly there are two markets. Okay, you have Mumbai and you have, say, New York. Okay, there are two markets. You refer the London, Mumbai interbank lending borrowing rates and the American interbank lending borrowing rates, and supposingly you say, for simplicity I'm rounding off the figure, but it's not that far from real. Say in Mumbai it's 10% per annum, okay, and in New York it is 5% per annum. Okay, now we'll understand in this particular chapter in different exchange rate theories that real rate across globe would normally remain same. Okay, if the real rate is not same in different economy, then there is a huge arbitrage opportunity. Okay, and because of arbitrages that we're trying to discuss, being a kind of a player who exploits such opportunities, so the market comes to equilibrium. Okay, so when we are saying in India it's 10%, it's only because maybe 8% is your inflation, so 2% is your real rate. And in New York, if it's 5%, still 2% is the real rate, but then the inflation there is 3%. So the moment inflation in any economy starts going up, okay, the interest rate would move accordingly. Okay, so you have this piece of information. You have Mumbai interbank okay, lending rates, and you have New York interbanks borrowing rates, supposedly 5 and 10%, and you call your bank, okay, or your dealer, and they say that a dollar is worth say rupees 60, okay, 60.00 supposingly, and if you say what is 1 month, okay, you say 1 month forward is what I want. Suppose if I don't want to buy a dollar today, I want to buy after a month, then obviously the basic concept is that since you're committing to buying a dollar in future, the dealers, the banks would presume as if they would buy it today and then hold it for a month to give you the delivery. Okay, so there would always be a concept of cost involved to it, and since the interest rate in Indian economy is higher than US, so it will be at a premium. Okay, so supposedly 1 month is at a premium of say 10 paisa. Okay, so it's 0.10. Okay, you ask for 2 months. It says it's a premium. We are going to discuss this, how do we calculate and what exactly are these quotations, but just trying to communicate what we understand as an arbitrager participating in this market, and predominantly to understand why India is a destination for FIIs, okay, or foreign investments. Now, supposingly the 3 months is at a premium of say 20 paisa. I'm just checking at random. Okay, so you have these 3 pieces of information. You have your information of prevailing rates, you have the borrowing rates in New York, and you have the lending rates in Mumbai, and just by these piece of informations you are now in a position to see whether there is an arbitrage opportunity or not. Okay, there are players in the market who keep a track of it, and they simply see whether they're able to make such kind of advantage in the market or not. Now what we'll do is I'm writing a thumb rule for dollar arbitrage. Okay, since we are dealing in dollars here and we are trying to understand an arbitrage process. So the thumb rule is, number 1, create assets in currency, or let's try and say create assets in currency which is going to go down, okay, and create liabilities in currency which is going to go up. When we are saying down, then we are talking of currencies appreciating, and when we are saying currency going up, then we are talking of currency going down is currency depreciation, and currency which is strong. When I'm saying currency strong in the sense, thumb rule for dollar arbitrage is create asset in currency which is going strong and create liabilities in currency which is going weak. Okay. Now this is another piece of information that you would look for. Now this is where your credentials would come, and you say that spot $1 is equal to ₹60. Now I presume that government and the economy and the development which is happening of late would make this go strong. That means 60 would become 58, would become 55, something like that. Okay, so rupee is going to go strong, so I'll create assets in rupees and I would create liabilities in dollars. Okay, now this is where you will have some observation. Okay, gradually once you find an interest in a subject, you start understanding it logically. But then what we're trying to say is that you always want to create an asset in currency which is going strong, and you always want to create liabilities in currency which is going weak, and by checking this you tend to make up a kind of arbitrage opportunity. So following this process, okay, let's try and see what would happen. So step 1, how do I create liability in dollars, okay, in New York? By borrowing. Okay, so supposingly I borrow say $100 for ease of calculation for say 3 months. Okay, now not necessarily all FIIs will borrow. Okay, FIIs will have their own resource as well, and they might use it as an opportunity cost. Okay, but then if I borrow $100 for 3 months, at this very point in time I know what my payables are. Okay, payables after 3 months would be you need to pay the principal of $100 plus you need to pay interest on that. Okay, so interest at 5% per annum. Okay, because that is what the rate is there. So rate for you is 5% per annum. So it becomes for a quarter 1.25. So $1.25 is what you're paying as an interest. So you know at this very point in time that I need to pay $101.25. Okay, you know what your payables are. Fine. Now following this thumb rule of creating asset and creating liability, so you have created liability in currency which is going weak, say dollar, and as such you don't invest dollar in India, as foreign currencies are just commodities in India, so you need to convert them into rupees. Okay, the process is basically that the nostro account gets credited, and accordingly in interbank market that much amount of rupees on the conversion rate which is prevailing, exchange rate which is prevailing, you get your rupees in your account. Okay, so the second step would be that you convert $100 at spot rate. Okay, at spot rate, so you get how much? 60 rupees is your spot rate. Okay, so you are getting 6,000 rupees. Okay, now